Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the sloping flag pattern, a powerful yet often misunderstood formation in technical analysis. This pattern can provide valuable insights into potential trend reversal, offering you an edge in your trading strategy. Understanding how to identify and trade the sloping flag pattern could significantly improve your ability to anticipate market movement and make sure you make informed decisions. So stay tuned as we break down this key strategy of this pattern, explaining how it differs from traditional flags and provide you with a step-by-step strategy to capitalize on this formation. So by the end of this video, you would understand this new tool in your trading arsenal and could help you spot potential opportunities that you might miss out on. Now we will look at some key characteristics of this slope pattern, and they include a formation of a strong price movement. First of all, you will see a strong price movement either to the upside or to the downside, followed by a consolidation phase sloping in the direction of the prevailing trend. You see a consolidation phase. This is the consolidation phase sloping in the direction of the phase. As you can see, this is sloping towards the direction of the move. You can see it's sloping to the upside. After we saw a pole, you can see price is sloping towards the upside. It has a parallel trend line forming this flag pattern. So with this, you can deduce that there will be a parallel line forming in this area. Let's clear the chart and draw a parallel line. You can see this is our parallel line forming in that direction. This is basically what it is. You can also see this one in this area. After the pole, you can see a parallel line forming in the direction of the flag. As you can see, this is typically an example. This is the best example. You would also see a decrease in volume during the consolidation, and if we look at this area and the volume, we can see there is a substantial decrease in the volume in this part of the flag pattern. Now the slope flag can be either bullish or bearish depending on the direction of the overall trend. For a bullish slope pattern, it forms during an uptrend with flag sloping to the upside, as we can see, while a bearish slope flag it is formed during a downtrend and the flag is sloping towards the downside, and we can see this is the pole and we can see it is trending. It is forming a parallel line towards the downside. This is basically the pattern we are looking for. After we see this, we see a slope forming towards the downside before we see an extension. This is basically what we are talking about. So let's see how we can exploit this slope flag pattern in our trading strategy. First of all, you start by identifying the pattern. Once you recognize the pattern, the potential slope flag pattern, you look for a strong trend followed by the consolidation phase that slopes in the direction. Ensure that the flag forms parallel trend lines, and you can see we have drawn the parallel trend lines. They are parallel to each other. This is the flag pattern that is sloping towards the direction of the chart. We have to ensure that the pattern adheres to the characteristics that we discussed, where it consolidates in the direction, it forms a trend line and has a decrease in volume. It has a decrease in volume. This is basically what we are talking about. If you can see in this area where the pattern was formed, you can see there was a substantial decrease in volume, signifying that there was no activity, no volatility during the consolidation phase. So after we have recognized this pattern, we would look for our confirmation. Once you have identified the potential slope flag, wait for your confirmation. The key signal is a breakout from the flag in the opposite direction. This prevailing trend often breaks out, accompanied by an increase in volume, which adds validity to the potential reversal. Now, after the confirmation, you enter your trade by placing orders immediately after the breakout candle close. For a more conservative approach, you might wait for a retest of a broken trend line before entering. This can provide a better entering price but carries risk of missing out or move if price consolidates. Now this is what we are talking about. When price slopes to the upside, we have to wait for price to break out in its opposite direction. And as we can see in this area, when price sloped to the upside, it broke out in this area, closed and retested the trend line. This signifies a strong opportunity for you to be selling this trade. You can sell at this area when it has broken out in the opposite direction. Once we enter, we wait for price to come back and retest the trend line. As we can see, we are entering a sell position at this area. Where do we place our stop loss? Because risk management is crucial. We place our stop loss beyond the high or low of the flag pattern. We can place it beyond the high of the flag pattern, or in terms of a buying trade, we place it beyond the low. These levels depend on whether they are bullish or bearish setup. The levels should be far enough to avoid premature stop loss due to market noise. So we are saying that this stop loss level would be far enough in case market wants to reverse on us. It will be far enough to anticipate false breakout, and this will help us reduce market noise but close enough limits to potential losses. It is far away from areas where price will stop you out prematurely. Where do we set our take profit targets to? We measure the length of the pole, of the flag pole, and project our take profit, our reasonable take profit target to that potential move. So by projecting, I mean we will use our estimated range, our time range indicator or tool, and we project the range. As we can see, this is the range of our flag pole. Then we project it from our entry area to where we anticipate price will get to, and this is where we set as our take profit target. This is how easy it gets, and this gives us a risk to reward of 1:3. As you can see, this is all you need to know about this sloping flag pattern. Once you have considered placing your take profit target in a reasonable area, we can also consider using multiple take profit levels to ensure gains as price moves in our favor. We can use multiple levels, like we can use a previous support area to take partial profits. We can take partial profits in this area. We can also take partial profits when price gets to this area too. You can take partial profits in all these areas so that you will be gaining in case price decides to reverse against you. Now let's not forget risk management. Always adhere to a sound risk management. We adhere to a sound risk management principle that aims for a risk to reward of at least 1:2 or 1:3. This is the minimum risk to reward we should be aiming for, and we should never risk more than 1 to 2% of our trading account on a single trade setup. So when you are taking a trade using this strategy, never risk more than 1 or 2% of your trading capital per trade on any single trade, regardless of how confident you feel about the setup. So you need to practice this strategy on a demo account. See how you can spot all these all these sloping flag patterns on your chart before you apply them to the real market condition. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.